Good morning. Good morning, Professor Delicate. Good
Good morning,
morning, Prof.
Edward. Good morning.
Okay, I can't tell you. Let me check.
Can you hear me now? Hello?
I can't hear you.
I can hear you. Hello, can you guys hear me? Hello, Cynthia.
Hello, good morning, sir.
Yes, you can hear me, right?
Yes, we can hear you, sir. I can, sir.
Okay. So it's just the presenter that we're trying to sort out this camera.
Hello, Prof. I can't hear you.
I can hear you clearly.
Akin, hello? What was wrong? I can't hear anybody. What should I do? No, but they can hear me, but I can't hear them.
No, we muted our mic. You can't hear us now.
Okay, let me see. Okay, it's like it's like I muted my mic. Yeah, it's like I muted my speaker. Okay, let me check now.
We can hear you. We can hear you.
Okay, thank you.
So, Mr. Edward, can you hear us now?
Yes, I can hear you.
It's been a long time. How about you now? And thank you for accepting our invitation. We consider this as a honor and a rare privilege indeed for you to have accepted our invitation for this February monthly seminar.
Thank you,
So I'm
Prof.
sure the students will have a lot, to gain from your experience. So let me be sure that the coordinator is there, so that immediately I do the introduction, I will hand over to him. Mr. Coordinator, are you there? All right, so I think it's 10 o'clock. We should start. So good morning, everyone. Good morning to our... Okay, so let me do the recording, please. Sorry, so I'll start all over again.
Good morning, Mr. Edward.
Good morning, sir.
Woo.
Yeah, hello, good morning.
Good morning, sir.
Hello?
Good morning, sir.
Hello, good morning, sir.
Good morning, sir.
That citation of that guy. Can you open it for me?
Okay, so let's start the presentation. Good morning, everyone.
Good
And
morning,
thank
sir.
you for joining this monthly seminar series. As part of our engagement with the experts in the industry, the department always reach out to risk management professionals, insurance professionals, and pension professionals to come and share their experience with the students every month. This is a way of ensuring that the theory that is being taught to the students are linked directly to the practice. So we are very lucky to have one of the experts in financial risk management in the industry to speak to us in the person of Mr. Edward Ifeanyi. Mr. Ifeanyi will be discussing on impact of microeconomic variables on market risk portfolios, interest rates, forex, inflation, and liquidity transmission channels. And I'm sure at the end of the day, our students will be highly enriched. To commence this seminar, I will hand over to the coordinator that will take us through. Mr. Coordinator, please kindly take over and let the seminar start.
Thank you, Mr. Eshodi. I welcome everyone again once again to our seminar series. And to present for us today is Mr. Ifeanyi Edward. Mr. Ifeanyi Edward is a ACI dealing certificate holder, a senior Pan-African market and liquidity risk executive that has served as group head of market and liquidity risk at leading international banking group with operation cut across Africa, Europe, Middle East, and even the North America. He oversees enterprise-wide governance of traded and non-traded market risk, IRRBB, liquidity risk, counterparty credit exposure, and stress testing framework across more than 20 jurisdictions. His expertise spans Basel III liquidity standard, advanced value at risk methodology, which include Monte Carlo simulation and backtesting validation, behavioral liquidity gap modeling, and cross-currency balance sheet risk optimization. Mr. Ifeanyi has led Treasury Transformation Program, risk engine enhancement, and regulatory harmonization initiative across multiple supervisory regimes. which include the Central Bank of Nigeria, the WAEMU, CMAC, and the UK PRA environment. Is also a CFA chartered holder, a certified financial risk manager, and is recognized for combining quantitative depth with executive clarity. So Mr. Ifeanyi is here to present to us a seminar titled The Impact of Microeconomic Variable on Market Risk Portfolio, Interest Rates, Forex, Inflation, and Liquidity Transmission Channel. I present to you Mr. Ifeanyi Edward. Over to you, Mr. Ifeanyi.
Good morning, Mr. Gunstein.
Good morning,
Wow. So, good morning, everyone. Before I start,
Mr. Edward.
good morning. Before I start, I will want to just tell you a bit about my background, how I started. So, I started as a village boy. My desire was to be a science teacher. I actually started with physics, but I ended up as a city boy. So I can tell you that both P2B and Bola Ahmed Tinubu, they are actually copying what I have been through from a village boy ending up as a city boy. So on that note, I want to go straight to my presentation for today. And before I start, please, I want to beg all of us, please, if you don't have the platform, please mute your mic so that the conversation today will be very orderly. So for today, we'll be looking at the impact of macroeconomic variables on market risk portfolios. So we'll look at interest rates, effects, inflation, liquidity, and how all these factors are being transmitted to market risk portfolios. So before I start, it would be nice to just to give us an overview of what we intend to achieve at the end of this conversation. So the first one is we will be able to appreciate the meaning and the scope of market risk portfolios, and then we'll begin to have conversation on what are these macroeconomic variables or factors and what are the implications, how do they influence the value or how do they influence activities on market risk portfolios. And then we'll have some conversations around how do we manage these exposures? How do we hedge these exposures in organization? The reality is whatever we do in every institution is affected by macroeconomic variable, is affected by the macroeconomy. So market risk begins in the macroeconomy. Financial crises, they are as a result of macroeconomic imbalances, macroeconomic variables. And what happens is you have market risk portfolios. These market risk portfolios, based on what is happening in the economy, those developments in the economy rub off either positively or negatively on market risk exposures. And those variables, like I mentioned earlier, talk about interest rates, FS, and the other ones, and how they impact on market risk portfolios. And then it's also interesting to note that when there's liquidity crisis is amplified, the impact of these macroeconomic variables on market risk portfolios. So it is important that as risk managers, as a risk manager, I must tell you that the major thing that you need to be mindful of is how are macroeconomic indices, how are they moving, how are they changing? Because be it credit risk, liquidity, market, or even strategic risk, or any other risk that you can talk about, those risks crystallizes, right, due to evolving macroeconomic variables. These variables are not static, they are not constant, they are always changing. And it depends on where you are sitting in the plane. That is what will determine how the movement of these variables will affect your portfolio. So for market risk portfolios, so let's look at some risk so that we'll begin to appreciate what we mean by market risk portfolios. So if you come to the radar of market risk, so we have what we call interest rate risk. And what does it mean? What it means is when there are changes in interest rates, when interest rate is moving up or interest rate is moving down, it affects your portfolio. It is either it is improving the value of your portfolio or it is reducing the value of your portfolio. It could also mean that you are generating more interest earning due to how interest rate has moved favorably based on the kind of position that you have. It could also mean a situation where due to the movement of interest rates, you are incurring more interest expenses. Therefore, in that case, you will say that movement is an adverse movement. So for interest rate, we're looking at how does your portfolio, how does the value of your portfolio, how does it change in terms of the value of the portfolio or the earnings that this portfolio are generating that are related to interest rate. You talk about equity. If you have an equity position today, if there are changes in equity prices, if the prices are going up, how does it affect your portfolio? How does it affect your earnings? If the prices are going down, remember in the market, when prices are going down, it is favorable to some people. When prices are going up, it's also favorable to some people. Whereas it could also be the other way for some people. So when the market is going up, some people are benefiting. And when the market is going up, some other people are losing. You talk about FX. When there is a change in exchange rate, if you have dollar today, your prayer will be that the naira will continue to depreciate. Whereas for someone who has an FX obligation to meet in the future, that person's prayer will be that exchange rate should go down, that the naira should strengthen. So it means the movement of foreign exchange rates has an implication on your portfolio of foreign currency, of your portfolio of gold. The same thing with commodity. Commodity, we talk about cocoa, we talked about different kind of commodities. If there's an increase in commodity prices, how does it affect your position? How does it affect your investment? You talk about trading book. When we talk about trading book in the industry and in line with accounting requirements, you are expected to maintain 3 types of portfolio. The first one is what we call held for trading. It's a portfolio that you hold, and the whole essence of holding that portfolio is for you to buy and sell whatever you have in that portfolio. You also have a portfolio that we call available for sale. Which please, can you mute? Before I started this class, we laid down the protocol, and the protocol was if you must unmute, then it means I'm handing over the floor to you because we want an orderly conversation. So please, let's not distract this conversation. So I said in the industry, based on IFRS requirements, you are expected to maintain 3 types of portfolios. The first one is what we call a head for trading. In accounting term, it is called fair value through profits and loss. We have the second one, which we call available for sales. And what it means is you are holding either to maturity, but if for any reason you have strategic reason or intention to sell that instrument or that portfolio, you will not hesitate to sell that portfolio. And we have the last one, which we call head to maturity. So any investment that you categorize as head to maturity, you are expected to hold this until maturity. All right. So in the trading book, based on that category, so I want to practicalize this. So it's like I am Ifeanyi, I have a car, right? The car that I have, the whole essence of buying the car is because I need the car for my day-to-day activities. So in that case, based on the 3 portfolio classifications that I have mentioned, it means for me, it will be head to maturity because the whole essence of buying the car is not to be selling the car. I'm not a car seller, I'm not a car dealer. But for another person who is a car dealer, that person will be buying these cars to sell the cars. So in that case, these cars in the portfolio of the other person, let's say Andrew is a car dealer, he buys and sells cars. So for Andrew, this same car that I have classified or I have categorized as head to maturity, Andrew will categorize this as head for trading because the whole essence of buying the car, you should be buying and selling the car. So he buys the car at a low price and the intention is to sell the car at a higher price, or where there are opportunities, he will sell cars ahead. Maybe he will sell a Toyota Camry. He doesn't have the Toyota Camry, but he will sell this. He will look for another car dealer who can give him the Toyota Camry. He will deliver the Toyota Camry to Paul Ajayi. And then why is he doing it? Because he expects that in the future, or maybe in the next 30 days, or in the next 1 year, due to government policy, that the prices of cars will drop. So what he has done is he has sold this hoping that the prices of cars will drop. And if the prices of cars drop in the future, he will buy that car at a lower price and deliver to Mr. Paul Ajayi. But remember, he has sold that car at a higher price. And all these prices, these price movements are happening. They are a function of macroeconomic variables. So now, when we come to the trading book, which is the one that you're buying and the whole essence is to buy and sell, we have what we call credit risk in that portfolio. So there are 2 types of credit risk. The first one is pre-settlement risk, and the second one is settlement risk. So what happens is Mr. Paul Ajayi has a car, and he has a Mr. Gustin who has entered into a contract with him, and that contract is Mr. Gustin has committed that he is buying a Toyota Camry from Mr. Ajayi in December. So we call this kind of contract a forward contract. So today, and why is Mr. Gustin doing this? He's doing this because he anticipates that he wants to buy a car in December. He doesn't have the money now. The fund will come in December, but he has a feeling that based on the movement in the macroeconomic variable, that exchange rate will worsen in December. Remember, we don't manufacture cars in Nigeria. We only import cars. So, and the cost of car is a function of exchange rate. So because he anticipates that in December, exchange rate will move adversely, Naira will depreciate significantly. So he wants to hedge his risk. Therefore, he's entering into that contract with Mr. Paul to buy a car in December, right? But they have agreed the price today. So if before December it happens that exchange rate is, Zulia, you're distracting the class, please. So if in December it happens that the Naira, instead of depreciating, has appreciated, Mr. Gostin, if he is not honorable, Julia, please, can you mute your mic? Julia, please, can you mute your mic? Julia, Diana, please, you're distracting the class. Please mute your mic. Thank you. So if Mr. Gostin does not have integrity, what will happen is if the Naira is appreciating, if the Naira is strengthening, Mr. Gostin may not honor that contract in December. He may walk away. So in that case, you will say a pre-settlement risk has crystallized because you have not given him, you've not delivered the car to him. You have entered into an agreement that he will buy the car in December, but because exchange rate has moved against him, if he end up buying that car in December, he will pay a price that will be higher than the prevailing price of that same car in December. Therefore, because he lacks integrity, he will walk away. So Mr. Paul would have made some losses to replace that contract. Whereas for settlement, Mr. Paul has delivered the vehicle, but Mr. Gostin failed to make payment, or Mr. Gostin has made payment, but Mr. Paul failed to deliver the car. So in that case, you will say a settlement risk has crystallized. And then for liquidity, remember, liquidity has to do with your ability to meet your obligations as they become due. And when it comes to liquidity, we have majorly two types of liquidity risk. So you have the one that relates to how are you able to fund your obligation? How are you able to meet your obligation? You're a tenant, you have a rent to pay at the end of June. How are you able to structure your cash flows? Supposing you are a tenant and you work in Unilag, so every month you're paid a salary. How do you structure, and that is the only source of income for you. So how do you structure your salary so that in June, when your annual rent is due, you are able to meet your rent payment? So that is funding liquidity risk. And if you are unable to structure your receipts, your inflows in such a way that you're able to meet this obligation, when your next rent payment becomes due, then it will lead to a liquidity crisis. Then the other one is where you have investment, you have invested in some assets, but you have obligations to meet. Now, it is a problem for you to convert this asset to liquidity. So it's also part of liquidity risk. And if you look at my left side, you will see what we mean when we talk about market risk. So market risk is the risk of losses in your on-balance sheet, your assets, your liabilities, and your off-balance sheet, your contingent, your commitment. For instance, when you guarantee somebody is starting a job today, and you now sign an agreement to be the person guarantor, you're carrying a form of risk, which we call an off-balance sheet risk. Because if tomorrow something happens there and the person is liable. If the person is unable to cover the charges or the losses, the organization will be coming to you. So it means as long as you have issued a guarantee to be someone guarantor, you also need to put that into consideration as an individual when you're planning your liquidity management initiative or when you're looking at your liquidity profile. Okay, so this is just to look at the macroeconomic variables, the macroeconomic factors. So like I said, they are not constant, they are variables, right? They can be anything tomorrow, right? And whatever they are tomorrow, the impact will be based on the kind of portfolio that you have. For instance, if you have given a bank your money for 1 year fixed deposit at a certain rate and inflation rate move up, the expectation is that because inflation rate has moved up, your real return will reduce. But in this case, you have locked yourself for 1 year. The implication is as long as interest rates keep going up, the value of your investment will be dropping, because if you want to look at the value of your investment today, what you will do is to present value that investment. And when you want to present value an investment, it means you're discounting that investment. And if you want to discount that investment, you're going to use a higher discount factor because inflation rate has moved. And if inflation rate moves, the expectation is that interest rate will also move. And when you use a higher discounted factor to discount that investment, you'll be getting a lower value, right? Whereas if you have put your money on a 7-day fixed deposit and interest rate changes, interest rate move upwards, you will just wait for 7 more days and you will be able to take advantage of that upward movement in interest rate. This is also the other way. If you have an investment that is maturing today and interest rate is going down, you will be exposed to what we call reinvestment risk, because you'll be coming to make that investment as a lower return. So your return will reduce. Okay, so this is just a trend of the MPR, just for us to know. Remember the MPR, monetary policy rate. The central bank in Nigeria, they meet every 2 months, and when they meet, they consider a lot of macroeconomic variables. The whole essence is they want price stability. They want stability in our exchange rate. So they look at the drivers, which are also these macroeconomic factors, these macroeconomic variables, right? And when they look at these factors, like what they just did recently, they reduced monetary policy rate by 50 basic points. All right. So monetary policy rate is like the benchmark rate. Is every other behavior is anchored more or less on the monetary policy rate. Okay, this one is also speak to exchange rates, just for us to know that we are in uncertain time. What it means is these variables, they don't wait. They don't wait as a place for 1 year. They don't wait as a place for 5 years. They are always changing. The only time where the exchange rate will not be changing is where you have a currency peg. Remember, when it comes to currency management, you can decide to float your currency. You can decide to manage your currency. You can also decide to peg your currency. For instance, in the UOMA and the CEMAC region. So I'm talking about the Senegal, the Burkina Faso, the Cameroon, all those French-speaking countries in Africa, their currency is pegged to the euro. So if you are making any investment in their currency, which is ZAF and ZOF, you are not exposed, you are more or less not exposed to changes in exchange rate. Okay, so like I said, so the macroeconomic variables, which we've talked about inflation, we've talked about policy rate, we've talked about FS. For fiscal imbalance. Remember, if our foreign reserve is very, very weak, the tendency, what is expected is that there will be pressure on exchange rate. Exchange rate will continue to worsen. If we have a current account deficit, all right, look at what has happened. Look at how the Naira is strengthening, because with the coming on board of Dangote refinery, crude fuel import, which used to constitute a lot of our import, has reduced because we are getting local supply. So the pressure on exchange rate is somehow being moderated due to Dangote refinery. All right. So from the macro shock, right? So it will translate to financial variable. So you will see the yield curve. You will see the yield curve changing. Maybe the yield curve will shift, or the yield curve will drop, or maybe rate at the short end will go up, or rate at the long end will come down. So you will see the spread between corporate bond and government bond. You will see the spread either widening or closing up, depending on how these macroeconomic variables, how they are moving, and also is a function of your individual portfolio. And then these movements, these variables will impact on your portfolio. And when they impact on your portfolio, you also try to quantify the impact. So you use some metric like DV01, mark to market, net interest income, sensitivity, economic value. So you look at this movement in this variable. For instance, if you have $1 position today, let's assume I have $100 today. My prayer, even though I'm a Nigerian, would be for the exchange rate to continue to worsen, so that the Naira equivalent of my $100 will keep getting big and bigger. So, but if exchange rate, instead of worsening, is improving, the Naira is appreciating, it means when I mark my $100 to market. So if I want to determine, if I want to sell this $100 today, at what rate, what will be the value that I will realize? Because Naira is appreciating, the value that I will realize will definitely be lower than what I paid to buy the $100. So that difference will be recognized as mark-to-market loss. Also, if I have a position, let's assume, okay, maybe when we get there, I'll talk about it because I have an illustration on this. So now, when all these things happen, the impact on your balance sheet. So it's either it is impacting on your earnings directly, but remember, anything that happens on your earning eventually will hit your capital. So if your earning is reducing, what is going to your capital will reduce. And if your earning is improving, it means your capital will also be getting more robust. This impact too could affect your liquidity. It could be such that because of the movement in exchange rate, you have some contracts that have underlying margin arrangement. So margin is a situation where if something happens, you have to provide more collateral to the other counterparty so that that counterparty is adequately hedging his risk exposure. So it could be such that maybe there's something has happened in the market. For instance, imagine if the central bank comes out today and say a cash reserve requirement on deposit has been increased to maybe from 20% to 50%. What it means is a lot of players in the financial industry, they'll be running around to look for liquidity to be able to meet that cash reserve requirement. So if they have placements, let's assume I am Bank A, I have funding gap, I've gone to counterparty B to raise some liquidity, and central bank has come out to make this pronouncement, and counterparty B is not liquid enough to still allow me to hold on to that liquidity that he has given me. What will happen is, upon maturity, the counterparty is going to call back the fund. The counterparty is not going to roll over the fund, so I will be exposed. Right? So that is what I mean when I say it has implication on liquidity. Okay, so let's look at interest rate transmission channel. So interest rate transmission channel, we've talked about FX, we've talked about inflation rate, we've talked about a monetary policy rate. So if inflation changes, it has, or if there are changes in monetary policy rate, remember I said monetary policy rate is the benchmark rate. If there are changes in this rate, there are implications on the yield curve. The yield curve is a curve that shows you the market rate, market interest rate as every tenor. It will tell you, it will show you as 1 day, overnight, this is the rate. 7 days, this is the rate. 30 days, this is the rate. 90 days, this is the interest rate in the market. 1 year, 5 years, 20 years, depending on what is available and how developed that market is. So when all these things happen, they transmit messages to this yield curve. It could make the yield curve to go up. It could make the yield curve to come down. It could make certain segment of the yield curve to change. Remember, I spoke about 1 day, 7 days, 30 days, 1 year, 5 years, 20 years. So it could be such that the macroeconomic variable is making 30-day rate to go up, whereas 1 year rate is unaffected, 5-year rate is unaffected. It could be anyway. Now, when it's moving adversely, so you have funding dependency, you have taken fund from some people, you've taken a loan from a bank, for instance, and interest rate is going up. If interest rate is going up, for the bank that has borrowed money, or for you that has taken a loan from the bank, your funding cost will go up. Your interest payment, your interest rate on that loan will be increased. So you will pay more due to the macroeconomic variable and its impact on your portfolio. The same thing for a bank. If a bank has a loan and interest rate is going down, it means the revenue of the bank will be definitely affected, because those loans, as they mature, the customers will be rolling over or extending. In fact, even if those loans, they've not matured, the customer could go to other banks, apply for the same volume of loan at a lower rate, and use it to pay down their loan. All right. I've talked about mark-to-market impact. So when interest rate is going up or is going down, it has an impact on your position. And remember the relationship between price and yield. When interest rate is going up, the price will go down. And when interest rate is going down, the price of a fixed income instrument will go up. All right. And it has implication on liquidity. For instance, if you have a contract that is tied to, let's assume I have a contract and I've taken FX from a counterparty and I've given that counterparty, let's say, securities, okay, let's say treasury bill or bond, and we have an agreement with that counterparty that, look, every period, every day, we will look at the value of that dollar that the counterparty has given me. And anytime the value of the dollar falls short of a certain amount, that I have to provide more security. So what it means is, if exchange rate is moving against me, if exchange rate is increasing, the value of that investment will go down. So the dollar equivalent of that investment will go down, and I will need to provide more collateral to the other counterparty. Okay, so duration is a matrix that gives you an idea of how your portfolio, how they change in relation to movement in interest rates. But duration assumes that the way your portfolio changes is directly proportional to how your interest rate is changing. So it assumes a straight line, whereas the relationship is not straight. The relationship is a curvature, is a curve. Like when you plot the y-axis on the x-axis, it is not a straight line from the x-axis or from the y-axis. It's not a straight line. It is a curvature. So that is what convexities try to address. And what is DV01? DV01 is a metric that we use in the industry to have an idea of the possible implication of one basic point change in interest rate. So just to give you an idea of how changes in interest rate affect your portfolio. Remember, in the organization where I work, we don't run away from risk. Our major function is to take different kind of risk, but to take this risk within our risk appetite, to make sure that we understand the risk that we are taking, and to make sure that we are able to quantify the impact of the risk. And how do we quantify the impact of these risk exposures? It is by just estimating, by projecting how these macroeconomic variables, how they will move. This is either we are doing that through historical data. So we've looked at how these variables, how have they moved in the past? For instance, exchange rate, USD to NGN. How has this exchange rate moved in the past? So what has been the worst movement? So that is based on historical data. We can also assume what we call hypothetical position. So we just say, okay, if this factor moved by 1 basic point, by 1%, by 5%, by 20%, how will this impact on our portfolio? Okay, so let's just look at an example. Let's just demonstrate what we have been speaking so far. So look at this situation. You have a depositor. So let's assume that I have a Professor Adeleke who has gone to Wema Bank to open an investment account, a fixed deposit account, and he was able to get a rate of 20%, right? And the bank has also given out this money. Let's assume that what Mr. Professor Adeleke deposited was 1 billion naira, okay, at 20%, and the bank has gone ahead. Let's forget about the constraint around cash reserve requirement, liquidity ratio. Let's assume that the bank decides to give out all these funds, the whole 1 billion naira in the form of loan at 25%. So if you look at this, 25% against 20%, the bank is making a spread of 5%. Now, there are a lot of issues here. One, when depositors want to give funds to the bank, it is very difficult for them to place those funds, even if the intention is to keep those funds for a very long period. It is difficult in Nigeria for you to get an investor that we want to place a fund with the bank beyond 90 days. Most times, those funds will be placed maybe for 30 days. Now, when you want to take a loan, let's assume that Uchenna want to take a loan to buy a car. Uchenna will never take a loan from any bank, and he will pay back the loan in 90 days. It's impossible. Uchenna will never do that. I have not discussed with him, but I can give you that assurance that we will never do it. Even if the loan is going to be for 1 year, Uchenna will not do it. But Uchenna will be more comfortable if he's taking this loan from the bank and the loan is for a 5-year period or for a 10-year period. So what it does is it means his monthly repayment, his monthly rental will be very, very low would be very, very accommodating. So imagine a situation where the bank had given this 1 billion from Professor Adeleke at 20% to an Uchenna. Now, supposing that loan was for 30, the deposit from Professor Adeleke was for 30 days, and the bank is also giving Uchenna this same loan for 30 days. So in that case, the bank will not be exposed to any liquidity risk, because when the fund is maturing, that is also when the loan is maturing. And all things being equal, if there is no default from Uchenna, at the end of 30 days, he will return the 1 billion with the interest at 25%. And the bank will also return the 1 billion to Professor Adeleke with the interest at 20%. So the bank would have made a 5% spread. But let's assume that instead of a 30-day loan, Uchenna said, no, I can only take this loan for 1 year. And Uchenna is the only willing party ready to take this loan. If the bank decides to issue or grant this loan to Uchenna for 1 year at 25%, so initially, for the first 30 days, the bank is making a spread of 5%. Now, let's assume that inflation figure was released, and you could see inflation rate trending up. The MPR, the CBN, the Monetary Policy Committee, they've met, and looking at all the economic variables, looking at what is happening in the world, looking at the foreign exchange, looking at the trade component of import and export. Now they decide to say, no, we need to increase, exchange rate is worsening. We need to term it. Let's increase MPR. And they decide to increase MPR. What that means is interest rate is going to go up in the market. So upon maturity, if Professor Adeleke, if the bank want to retain this same 1 billion from Professor Adeleke will be telling them that, look, I can't take 20%. I need to enhance my real return. I need to defend my real return, right? I would rather take it to a Union Bank that will give me 25%, right? So what happens? If the bank is unable to retain that fund, the fund will go out of the bank. The bank will have to look for a replacement for that fund. And because rates in the market have moved up, if the bank is going to replace that fund, the bank definitely will pay a premium. The bank will attract the new fund at a higher cost, at a higher rate, above 20%. So what that means is after 30 days, the margin is shrinking if interest rate is going up. And if the bank is not careful, the bank may even end up replacing this fund at 25% or even more than 25%, depending on the macroeconomic situation at that point in time. And if that happens, it means the bank profitability for that period will be adversely affected. Israel Edem, is that raise your hand to ask a question or what?
Yes, sir.
Okay, go ahead.
Thank you.
Hold on. Professor Adeleke, am I allowed to take questions during the class, or should we take it after? So which one? Okay, but which one I can go ahead, but after your question, I want to get clarity from Professor Adeleke or the coordinator, how you want us to take questions. Thank you. Go ahead.
Okay, thank you very much, sir. And your training is very, very insightful. But I wanted to ask a question. How about in the case where the bank was giving the loan to Uchenna? There was a clause in the loan agreement that says that if there's any change in NPR and interest rate goes up, the bank is at liberty to also increase interest rate. Is that not a way for the bank to salvage that particular situation where Professor Deleke is saying that he's not placing his 1 billion with the bank because interest rate has gone up, except they increase the interest rate? That's the only way he can. And if the bank had a clause in their offer letter given to customers that in the case where there's a change in NPR, where interest rate goes up, the bank is at liberty to also do that. I'm just thinking if it can salvage or if it can salvage that or use that as what's called a short-term edge before the bank goes all out to also seek other funds where they can use to cover that. I was just thinking.
Okay, if I got your question clearly, okay, so you're talking about the clause that usually we have in offer letters to customers. Okay, so the reality is in Nigeria, most of the things we do in Nigeria, we are not doing this properly the way it should be done. So normally when you have a loan, you can have a loan that is a fixed rate loan. You can have a loan that is a floating rate loan. If a loan is a loan, right? So and when is a floating rate, it's floating on a benchmark. So if that benchmark changes, so if the loan is floating on MPR, for instance, it means every 2 months you expect the rate on that loan to either change, move up, move down, or remain the same based on MPR decision. So in that case, it's a floating rate. And then if you have a fixed rate loan, it means no matter what, come rain, come shine, the rate will remain the same until the end of that contract. Now in Nigeria, what happens is banks have those clauses on the contract letter, but they tend to act on those clauses when the conditions are not favorable to them. When the conditions are favorable, they close their eyes and move away. So if you have that clause that you're saying the pricing of the loan will be based on prevailing market realities at any point in time. Now, when the market move up, when rate move up, you'll be quick to write to the customer that you want to price the loan. But when the rate in the market move down, go and check. I've not seen any bank, right, that will write to the customer that the market rate has moved down. Because of that, want to price down your loan. That doesn't happen. So there is no equilibrium, there is no fairness, if you ask me, right? So banks are putting that clause to exploit customers. That is my own personal view, right? So, but in the developed world, it is either you're taking a fixed rate loan or you're taking a floating rate loan, and this is clear from the beginning. So if it is fixed, no matter what happens, the rate doesn't change. Just like if you buy a bond, you get a coupon, the coupon will never change. No matter what happens in the market, the coupon will remain the same, except if it's a bond that has a floating rate. Or not
Okay,
yet. Yes.
so Mr. Edward, so I feel we should just continue, although we want to make it as interactive as possible, but we would want a situation where you will have covered substantial part of your
Exactly. That's
slide.
also what I have in mind. So at least let
So
me
please,
do 30 more minutes.
Yeah, exactly. So please, participants, you will still have the opportunity to engage him. So let him quickly cover his ground, and then you start interacting with him. Thank you.
Okay. Thank you. Okay, so like I said, this is just a typical yield curve. So you can see I have 1 year, 3 years, 5 years, 10 years. It can extend to, in America, I'm sure it will extend up to 50 years. In America, you find people who are willing to keep their fund in banks for 50 years from the beginning, right? But that can never happen in Nigeria. You will not even trust the bank, that the bank will be alive after 30 days. So you rather do it for 30 days. After 30 days, you watch the bank again and roll over, even though the intention is to leave it for your great-grandchildren. So, like I said, so this is the yield curve. You can have a situation where there is a parallel shift in the yield curve, all right? So it's either parallel shift upwards or downwards. It could also be a situation where the 1 year, let's for instance, look at the blue line. This could be a situation where on this blue line on the 1 year side is dropping to around 4. This could be a situation where the blue line around 1 year is moving up to 20%, whereas the 5 year, 10 year is not even changing. It could be a situation where 1 year, 5 year, and 20 years, they are changing. 3 years is not changing. 7 years is not changing. A lot of things, it can move either way. There is no defined way for it to move, right? It is not like the kingdom of God where, except you are born again, you will not make heaven, right? So this one, you can make the heaven. It can pass through any route to make its heaven, okay? So now I talked about DVO1. This is a core market risk metric. Like I said, in market risk, we have portfolios that are sensitive to changes in interest rate. We have portfolios that are sensitive to changes in interest rate, right? So if you have a portfolio that is sensitive to changes in interest rate, one of the easiest things that we do is we try to compute the DVO1. So this DVO1 is saying if there is a movement in interest rate by 1 basic point, that is 0.0001, how will that affect our portfolio? It is either our portfolio value will increase or our portfolio value will decrease, but our portfolio value cannot remain the same except if there is no movement in interest rate. So what that means is for somebody who has invested in bonds, for instance, if interest rate is going up, the value of your bond portfolio will go down because, like I said earlier, there's an inverse relationship between interest rate and price. If interest rate is going up, the value of your portfolio will go down. And if interest rate is going down, the value of your portfolio will go up. And one of the fastest ways, one of the quickest ways to determine the impact of interest rate changes on your portfolio is to estimate the DVO1. You can also extend this to your FX. So you can also, for instance, for some of us who speculate, when you want to save money, you don't save your money. Some of us, we don't save, our savings are not maintained in Naira, our savings are maintained in dollars. So when we save up to a certain amount, we buy dollars and keep the dollar because every Nigerian believes that exchange rate will continue to worsen. Remember where the rate was before Jagaban came on board. Remember where the rate is today, even though we are seeing some level of stability and appreciation. But the general consensus is that we don't really have what it takes to sustain this, right? So that is just a general view of the average person on the street. Okay, so let's look at foreign exchange. So foreign exchange, remember, is one of the market risk factors, is one of the macroeconomic variables, and there are a lot of drivers. For instance, your external debt. If you're so exposed in terms of your borrowing, external borrowing, that's an implication on your exchange rate. If inflation rate is high, so as long as inflation rate in Nigeria is higher than inflation rate in America, right? Because there's a relationship between inflation rate and interest rate, is to also show up on the exchange rate, right? And when you have currency mismatch, it amplifies your exposure to foreign exchange risk. And the truth of the matter is, for an institution, a financial institution, it's difficult for you to insulate yourself from foreign exchange movement because you can never have a situation where your foreign exchange assets, foreign currency assets, will be equal to your foreign currency liability. So as long as your foreign currency assets and your foreign currency liabilities are not the same, so it means you have an open position, and that open position will always change as exchange rate changes. Whereas for non-bank organizations, they can hedge their currency risk by coming to the bank, right? So when they come to the bank, they can engage in a lot of transaction or in a lot of trades that will help them depending on availability of those trades. For instance, they can do a forward where they want to buy FX in the future, but because they are worried that exchange rate could worsen in the future, they want to lock in the exchange rate today. They can also do what we call option, right? Option is a derivative. So it gives you that power. So you agree on a price today, what we call strike price, but it is happening in the future. So now in the future, the option gives you the power to decide to say go ahead with that contract. So if in the future, the price that you agreed for that contract is not favorable to you, what you do is you just walk away. But if in the future, the price is favorable, you will exercise the option. So how do I mean? For instance, if I want to buy dollars in December, instead of going to a forward transaction, remember for a forward transaction, I've locked in the price, right? And I must honor that contract. So if I enter a forward contract today and the rate is to buy dollars at 1,008 in December, if in December dollar rate is 1,005, I would have made a lot of losses because I'm buying dollar in December. Dollar that I could have bought at 1,005. In December, the market moved against me. My projection turned out to be wrong, right? So now I've committed myself that I'll buy the dollar at 1.8, and the market ended as 1.5. So I have a 300 naira loss for every $1 that is involved in this contract. So it means I cannot even escape except if I'm not honorable. And if I'm not honorable, I will not fulfill the contract, which will be a crystallization of pre-settlement risk. Remember, when we talk about pre-settlement risk, it's like promising a lady that I'm going to get married to her, right? Now, the lady, not knowing that I was deceiving her, thought I was serious. And in the process, I impregnated the lady. And December, I ended up not marrying the lady. So that is like a practical example of a pre-settlement risk. So the marriage never happened, but the lady is pregnant. So whereas if I don't want to commit myself, instead of going for a forward, I will do an option if that product is available. So what will happen is I will pay a price to buy that option. So we have two types of option: call option, put option. Call option gives you the power, give you the right to buy as a price in the future, but that price has been agreed today. So let's assume that I bought a call option. I'll pay a little amount for the option, and then the price is 1,008 in December. What happens is if in December the price is above 1,008, I will exercise that option, the call option. But if in December the price is 1,005, the contract gives me the right to decide what I want to do. If I want to go ahead with the contract, if I want to cancel the contract. And in this case, because if I buy at 1.8, when I can get this at 1.5 in the market, I'll be making a loss. What will I do? I will walk away from the contract. So that is the advantage of an option against a forward. So option, I can decide to walk away if I'm not in the money, if I'm out of the money. But a forward, whether I am in the money or I'm not in the money, I must honor the contract. You also have what you call a swap. So a swap is you have Naira, you need dollar, you don't want to buy dollar, you just want to exchange. So you will give the other party your Naira, and the party pays you periodic interest on your Naira. The other party gives you the dollar, and you pay that counterparty periodic interest on the dollar. And then upon maturity, you will exchange your money, you will exchange your fund, your Naira will be returned to you, and you will return the dollar to that counterparty. Okay, so we've talked so much about inflation. So inflation is a silent risk multiplier. I remember I mentioned this earlier, that if inflation rate is increasing, what it means is your real return on your investment will be going down. Therefore, you want to be paid higher interest as inflation goes up. All right. And when inflation is going up, of course, the central bank will also want to respond because one of their core functions is to ensure price stability. So they will want to increase interest rates so that people will not be able to have so much liquidity. To remember, price is a function of demand and supply. So when they reduce liquidity, the demand for FX will shrink, right? So, but of course, when the interest rate is going up, you also see the impact on this thing, foreign exchange rate, right? So, and then when all this is happening, right, liquidity also has a way to amplify the impact of all these things. Look at what happened to Silicon Valley, right? Look at what happened to them. Yes, there was a problem. Everybody was facing the same problem. But because they had a run, because their portfolio was concentrated, right, they struggled to generate liquidity. So in the industry, or even in our personal life, the fastest thing that can kill anybody is illiquidity. Imagine a situation where, okay, let me say for Zulia, imagine a situation where today you're broke, but God forbid, today you're broke. But in December, you are going to get 10 billion naira. It's guaranteed that the government, federal government, will pay you 10 billion naira in December. But today you're very broke. If you are not able to survive till December, right, it will be a problem. It will be a problem. So in December, we may be looking for you, right? And it will be difficult to locate you. So liquidity is a very serious business. Liquidity can kill any institution. So it is something that every institution pay serious attention to, right? So, but I won't want to talk more on this because I'm trying to manage our time so that we can have like 30 minutes to engage in other conversation, like question and answer. So, and what is liquidity risk? So liquidity is your ability to fund, is either you want to make more investment. For instance, maybe Professor Adeleke want to buy a property in Banana Island, right? You need to fund this. So if he does not have that ability, then it means he's suffering from liquidity risk, even though it is not the one that can kill him. But the thing is, he won't be able to achieve that ambition. So liquidity means for whatever you want to do, you want to increase your assets, you want to meet obligations, you should be able to meet those obligations effortlessly without paying any premium, even if you have to generate liquidity, but it has to be as normal cost. You're not going to pay extra to generate that liquidity. When you pay extra, then it means you have a liquidity problem. And that is the only reason why you're paying extra. You're desperate to get that fund at all costs. So you are willing to pay anything as long as the fund comes in. So it means you are not managing your liquidity very well. Right. And most of the market risk factors, their implication on market risk portfolios, liquidity can also worsen it. And these are some of the signs. When you see these signs, maybe for banks, when you see these signs, you know that there is a problem, or there is a problem that is building up, serious problem. So these are some of the things. Maybe a bank, their risk asset is growing, right? But they are funding their risk asset with funds that are very, very volatile. If you have a fund, let's assume that Professor Adeleke gave my bank 2 billion naira today, and he's the kind of customer that the next day is coming to take his money. It will be a poor decision for my bank to invest that fund in a 1-year loan or a 2-year loan, knowing fully well that Mr. Adeleke is kind of customer, he will come the next day to take his fund. The rational thing to do is for the bank to invest that fund in a liquid asset. Remember, we talked about asset liquidity. You have an asset, but how liquid is that asset? If you want to generate money, it's like you have a house, a property in Banana Island, and somebody has a property in Oshobo, if you want to sell the two, I don't think you will sell the one in Oshobo before the one in Banana Island if the prices are reasonable. So what it means is the one in Banana Island has better access liquidity compared to the one in Oshobo. Or maybe you have a property, very big house in your village, and you also have the same kind of property in Lagos, and you have an obligation to meet, and you want to liquefy this asset. It will be difficult for you to liquefy the one in your village compared to the one in Lagos. So where you are funding assets, risk assets, remember risk assets are risky assets, and funding this asset with funds that are volatile, you're already creating a future problem for yourself. If your earning is declining, it's a problem. If you have concentration in your funding base, your deposit, you have a situation where you have a deposit base, you have just Mr. Deleke and Uchenna. They contribute 50% of your deposit base. Is a problem. The day Uchenna comes to your branch and the security man did not greet him properly, it will make him to just enter he will just say, well, what is this rubbish? I'm one of the biggest depositors in this bank, and this security man could not even greet me very well. He could not persuade. He could enter the bank. In fact, he may not even need to enter the bank. Just from his app, he will wire out all his funds. You can imagine, and that was exactly what happened to Silicon Valley in the US. They also had concentrated funds. They had funds that were coming from, majority of the funds were coming from just few customers, right? So, and when they were hit, those customers, when they began to pull out their funds, you can imagine the implication. If you have a situation where you apply for a loan in an organization, you have met all the conditions, but they are delaying, giving you different reasons. Our system is down, this one, for them to disperse, right? It is a sign that something bad is about to happen. So there are also other ones that you can look at. So how do you manage your liquidity risk? So what is mainly interesting for me, and which is what I want to speak on, is for you as an individual. How do you manage your liquidity risk? That you have a job today does not mean that you may not be out of job tomorrow. So to manage your personal liquidity risk, one of the things that is always advocated for is for you to ensure that as a minimum, your living expense for a month, you have savings that can cover your living expenses for at least 3 to 6 months. So that if for any reason you are out of job today, at least you have 3 to 6 months based on your reserve to be able to take care of yourself, pending when you are able to launch yourself back into the industry. So there are other ones too that you can go through and maybe review at your spare time. So let's just look at a situation where there are shocks coming from the macroeconomic variables that we talked about. So let's look at an integrated multi-factor shock scenario where MPR has been increased by 300 basic points. The Naira has depreciated by about 25%, inflation rate has increased 28%, and then there's liquidity freeze in the market, right? How will that affect your portfolio? So for the increase in rates, remember the rate sensitive portfolio that you maintain will be affected. The portfolio that you have that are exposed to changes in FS movement will be affected. So if we do the simulation, the impact on your capital, you could see your capital. Remember, your capital is a function of your reserve and your earning. So if you have negative earning, it is going to diminish your capital. So when all these things happen and your positions are adversely affected, so you could see a situation where your capital, due to the impact of rate shock, your capital is dropping by around 4% due to the impact of changes in exchange rate. Your capital is dropping by over 2% due to the widening of spreads, due to liquidity implication of this macroeconomic variable, your capital is dropping by about 1.5%. So by the time you add everything together, if you're not careful, you may be operating like in the banking industry, where capital is very, very key. If your capital is below the regulatory requirement, it's either you ingest more capital or your license will be withdrawn. So you will find out that the impact of all this could be so material. Okay, so these are some early warning indicators. When you're growing your loan book very aggressively, the yield curve is moving, the volatility on the yield curve is so high, your FX reserve, your country FX reserve is declining. It will push pressure on exchange rate, and then interbank spread is widening. So if interbank spread is widening and you're a taker of fund in the market, what that means is you'll be paying more interest expense to generate funds in the market. So this is just what we do in the banking industry. This is what we do in the banking industry to manage all these risks that we have spoken about today: interest rates, foreign exchange. So we have what we call fund transfer pricing mechanism. So the way it works is you have someone in the middle who is like the treasurer or who is like the treasury. So what he does is actually the one managing the risk, all these FX risk, the interest rate risk, the liquidity risk, is the one managing all these risks on behalf of the bank. So you have business offices in different locations in the country where you operate. These business locations, their work is to interface with customers, maybe customers that are bringing deposits and customers that are taking loans from the bank. So when they bring these customers, the bank pays these customers what we call interest expense for the customers that are providing liquidity. And when they bring the other customers, the customers that are taking away our funds, the bank will charge these customers interest income. So from the customers that are taking away our funds, the bank is generating interest income. From the customers that are giving us liability, the bank is incurring interest expense. Remember, in the economy, we have people who have surplus liquidity, but they don't have ideas, they don't have business ideas, or they are risk averse, they don't want to take risks. And you have people who are risk takers. They have a lot of business ideas, but they are constrained in terms of capital. So, but they have good credit rating, they have good collateral. So these kind of customers, the bank will give money to them. And for these other customers that don't have ideas, but they have money, the bank will take money from them. But as these things are happening, remember, we spoke about liquidity risk, we spoke about FX risk, we talked about interest rate risk. So as these things are happening, when we are taking money from customers, we are taking money from customers in different tenors, different type of taking. It could be current account, it could be savings account, it could be time deposit, and even for the time deposit, we also have different tenors. The same thing for the loan that we're giving out. We also have loans that we're giving out. Some of them are short loans, salary loan, some of them are long tenor loan. And all these things, some of these things are exposed to changes in foreign exchange movements. Some of these things are exposed to changes in interest rates. So you have somebody who sits at the center. What he does is he is the one that is rewarding these business offices that are supplying liquidity to the center. And he's also the one that is charging the business offices that are taking liquidity away from the bank. And what he's trying to do is based on market reality, based on what is happening in the market, in terms of interest rate, in terms of foreign exchange rate, it determines what he is rewarding the business offices that are bringing liquidity to the center. It also determines what he is charging business offices that are taking away liquidity from the center. And by doing that, what it means is the bank is conducting its business, but the bank is also making sure that it's conducting its business. It is also taking into consideration the play out in the macro economy. All right, so This is on strategic risk management framework. So some of the things we do, this is not all encompassing. This is just some of the things we do to manage risk in our institution. So one is duration management. Duration has to do with interest rates. So what you try to do is you try to do what we call portfolio immunization, if it's possible. So you try to immunize your portfolio. Remember, immunization, when we were small, I'm sure a lot of us, we took vaccine. The whole essence of the vaccine is to protect you so that you will never contact some diseases as you grow up. So the same thing too, when you immunize your portfolio against interest rate, what it means is whether interest rate goes up or interest rate goes down, is your net revenue from fund, your net income is guaranteed, right? But it's actually very difficult to do. But maybe in the developed world, they're able to do it because you have a lot of products that you can use to achieve this. But in Nigeria, you have limited products, even though Nigerian market is still ahead of a lot of markets in Africa. And then FX hedging. So FX hedging, if you have $100, for instance, right, because you are afraid, you don't know if exchange rate will move down against you. So you can decide to enter into a contract so that no matter how the rate moves, you've already fixed the rate in with that contract. Then funding diversification, I spoke about concentration. I also I cited the case of Silicon Valley. So, and even when I spoke about early warnings indicators for liquidity, I also mentioned about where you have your assets concentrated. If you have your loan book and you have one or two customers accounting for 80% of your loan book, is a problem. It's like you have an apartment. Maybe for someone who has a property and you have 6 tenants and another person has a property, the same amount. Let's assume that you have 2 people. They have the same amount. One went to Lekki to buy a property. Maybe the person bought a duplex, 3-bedroom duplex, and the other person went to maybe a solo to buy a 3-bedroom, to buy a property of 3 block of 3-bedroom. Now, if the rent are the same, so how do I mean? If the rent that I collect from the property in Lekki is 9 million every year, and the rent I collect from the property in the solo is 9 million, so each tenant is paying 3 million. Now, I'm more comfortable with the property in a solo because what does it do for me? The man that is living in Lekki could be out of job tomorrow. If he's out of job tomorrow, what it means is the concentration risk has crystallized. It will be difficult for me to get anything from him out of that 9 million. Whereas for the property in the solo that have 3 tenants occupying those properties, the worst that will happen is 2 of the tenants will be out of job, or 2 of the tenants will not be able to make payment, but at least I will still have 1 of the tenants that I will collect 3 million from. So if that is my only income, I will manage my life on 3 million, depending when things normalize, compared to what is happening in Lekki. If I don't have a solo and I'm just depending on the 9 million, it means for that year, I may even die, God forbid, before the tenant in Lekki, I'm able to evict him from the house, or he's able to recover from the job loss. So you also have value at risk, factor sensitivity. What is value at risk? So it's just to give you an idea using statistical tools to give you an idea of, and it's also looking at what has happened in the past. Based on what has happened in the past, you are just projecting the likely losses that you could suffer under a certain probability. So you could say, I am 95% sure that no matter what happened on this portfolio, in the next 10 days, I cannot lose more than this amount, right? And we'll have what we call back testing. So you project and then you look at what happened eventually, what your model able to project. So you don't want a situation where the reality is in excess of what your model has projected. And then you also don't want a situation where your model is projecting high losses, whereas in reality, the losses are very, very minimal. So, and which is also maybe one of the things you would have learned in your class. So there are also some tools that you use to check the reliability of all this output because they are statistical output. All right. So you conduct spec testing. Remember, we have something on spec testing that we call integrated. We are trying to simulate and see if these portfolios, if these macroeconomic variables, if they move adversely, how will they affect our portfolio? And what it does is it gives us an idea of where do we get to, and we say, no, we cannot take this anymore. It's like you're in a marriage, right? And maybe you have a husband who abuse you in the relationship. Maybe you could do a spec testing to say, okay, if this abuse get to this level, this will be the implication on my mental health. This will be the implication on this. So based on that spec testing that you have done, once the abuse get to a certain level, maybe the decision is to exit from the relationship. All right, so I'm just trying to personalize it so that we appreciate the conversation. So I've talked about early warning system. So you have a system. For instance, if where I work, I have a CBN requirement that says liquidity ratio should not be less than 30%. What I will do is internally, I will set a limit of 35% or 40%. So what it does for me is I won't get to 30% before I become aware, before I start thinking of what I need to do to shape up. So once it gets to 40, I know there's danger. I need to do something extraordinary so that it doesn't get to 30. And then liquidity buffer, I try to demonstrate liquidity buffer by citing an example of our personal life, the need for us to also have savings that can sustain our current lifestyle for a minimum of 3 months, so that in case if any of us today should be disengaged from his or her employment, people will not see you the next week and they are wondering if you are suffering from one serious ailment. All right. And then dynamic ALM, the governance practices, unlike in the past where bankers, they sit down in the offices and customers come to look for them, that is no longer the practice. You have to go out and look for customers. And then unlike those days where you have liability, you're looking for where to put this, or you have investment, you're looking for liability. No, this time around, because of market dynamics, you have to make sure that you're taking both decisions at the same time. As you're seeing opportunities, you're also identifying liabilities to fund it. Not a situation where you see opportunity, you invest, and now you're coming to look for liabilities. Remember these portfolios, they are exposed to macroeconomic variables. So what is our takeaway from this conversation? Macroeconomic variables, they drive market risk exposure. So in the industry where I work, you can never be insulated from movement in exchange rate, from movement in interest rate, but you just have to define what your risk appetite is. And when you define what your risk appetite is, you try to cascade is in terms of limit. You define limits. This is what I can take. This is what I cannot take, right? And that helps you to manage your portfolio very, very well. So transmission channels, what are these transmission channels? These are the macroeconomic variables, the market risk factors, the interest rate, movement in interest rate, changes in exchange rate, changes in commodity prices, changes in equity prices. These are the market risk factors, and they amplify the impact of macroeconomic variables on your portfolio. We had earlier noted that when these things happen and there's a liquidity event, the impact can be catastrophic, right? And SEC testing, like we said, should be forward-looking, because the whole essence is to check if you have the resilience to survive those events. They have not happened. They may not happen, but they could happen. And if they happen, you just want to be sure that you're well armed, you're well equipped to be able to withstand them when they happen. And leadership in risk management is about anticipation. So this is my advice for us as future risk leaders. So this is not just about formula, right? We need to master macroeconomic thinking. As risk managers, the major thing that determines if the value of our portfolio will improve or decrease, if our earnings will be sustained, will improve or will deteriorate, is actually a fallout of macroeconomic variables. It is also important as risk managers for us to develop quantitative depth. So, and very, very interesting for someone like me, while I was studying physics to be a physics teacher, I didn't know that my physics was actually preparing me to have a very robust quantitative background. And this is actually helping me a lot. Even right now, on my own, I'm actually studying Python because I have seen that with what I'm doing on Excel, if I can code in Python, what normally would take me 2 weeks or 1 week or 1 month to develop, if I want to develop a model, for instance, with Python, I can develop it within 10 minutes, right? Or run a lot of analysis within minutes instead of running it on Excel. It's also important for us to understand, for those of us that are in the banking industry or that we want to come to the banking industry, it would be nice if you begin to appreciate Basel III, ICAP and ILAP and other Basel III, Basel IV releases. It is important for us to build integrity and judgment, good judgment. More especially, risk management is about trust. Think systemically and live courageously. In the 21st century, an illiterate will not be someone who cannot read or write, but someone who cannot learn, unlearn, and relearn. I will close on this note. Thank you.
Wow.
Wonderful.
Very good. That was a very great presentation.
Wonderful.
Thank you very much for sharing your experience. So now the floor is open for questions, observation, and all the like. So the floor is open now. So you just indicate by raising up your hand using the raise up hand icon. So we'll start with Uzoma. Uzoma, please ask your question.
Good morning. Thank you very much to our speaker, Mr. Edward. It's really an insightful engagement. My question is this. I'm actually glad you ended your last line with Python. Now, with the age of AI, where you can literally put your command into a chat box, get your Python script out, everything is fine and running. Where do you think risk management and insurance is headed? Because AI can practically do everything. For once, I write codes, but I no longer do that now. I just put my what I want on a chat box. I get my scripts because I understand it. I know where it is wrong or where it's right, and I am good to go. So with that, since I can practically write my Python code within split seconds, where do you think risk management is headed in all of this?
Okay, thank you. Okay, so Uzamaka, thank you for that comment. I can also give you that assurance that what you said, I also do it, right? So I do it, and like you said, if you're doing this, you need to have clear understanding. Okay, for instance, there's a model that I'm developing, right? So liquidity, behavioral liquidity gap analysis, right? Now, in this model, I'm combining a lot of things and I'm working with AI to develop this model. So what am I doing? I'm bringing in VAR analysis and I'm bringing in different kind of VAR analysis. I'm looking at exponentially weighted moving average approach. I'm looking at historical approach. I'm looking at log normal approach, as in for the yield, right? I'm looking at historical. So now for my behavioral behavior for short tenure, less than 30 days, I'm using those VAR analysis to determine what should be the cash movement, maybe inflows for assets, outflows for liability. After the 30 days to 1 year, I'm using runoff, I'm using decay factor, I'm using regression to determine the core, I'm using minimum balance, I'm using a lot of things. So at the end of the day, what am I doing? I'm working with AI. I'll tell AI, this is what I want. I'll give AI data sample. AI will give me results. I will review it. If it's not in line with what I want, I'll go back. So what you're doing, I'm doing it. But I'm saying in addition to that, I am also learning how to, how to use Python for. It is not everything that will give AI. If I have my company data, I want to do some analysis, I may not give, it won't be right, it will be unethical for me to load that kind of data on AI, right? So yes, I'm doing what you're saying, but in addition, I'm also, it is something I've told myself that I will do in the next 3 months or 6 months, I should be good to go. So it's just a personal thing, right? Thank you.
Thank you very much. So, Mr. Edward, I think I will just take 3 more, 3 questions at a go, and then you respond before we take another set. Would that be okay?
That's fine.
Okay. So, on Oyemi,
sorry, what I also want to say is, if it's possible too, maybe the participant, they can drop their questions on the chat box. I think that will be faster. So if they can just drop it. So instead of speaking, I think we'll be able to manage time if the drop is.
All right. So you will be reading directly from the chat bar and then you'll be responding.
I can see it from my end. I can see the chat box. So if they drop, I will be able to see it too.
All right. All right. So please go ahead, type your questions. But while others are typing, I think I will just allow Onoyemi alone. Sholanke should type. Tabo should also type. Onoyemi, please go ahead while others are typing. So.
All right. Good morning, highly respected head of the department, Professor Adeleke. I also greet you, sir, our speaker, Mr. Edwards, and all other protocols observed. You mentioned about how interest rate actually affects the business, talking about, and you talked about floating and fixed interest rate. In the case where a loan has been given out and it's a floating one, and the company that actually takes the loan actually use the loan for, let's say, 70% fixed assets, and immediately he took the loan, maybe some months after he takes the loan, the interest rate increases, and he sees that it will not be favorable for the business. How do we handle that? I want to give a practical example of my own business.
No, you don't need to give a practical example. It's okay, I got the question.
All right, sir. Thank you, sir.
Okay, Dr. Adeleke, are we taking any comment? Okay,
no,
I can see Sunday's comments. So
yes, others will type. So it's the only one that will speak. Others will type. So you just take them as you see them. But you can respond to his own. Then the rest you'll be reading from the comment section.
Okay. So Onayemi, you were the one that spoke, right?
Yes, sir. Yes, sir.
Okay. So you said a situation where a company has taken a loan from a bank, and the company has invested 30% of the loan in a fixed asset, and then all of a sudden the interest rate increase. All right. So the loan is a fixed rate loan, right? Or is it floating?
It's floating, sir.
Okay. So normally remember that as an organization, and that was why I hammered on. So when it comes to investment decision, the fundamental driver is your view about macroeconomic variables. you must have a view, right? You must have a view. Now, you may not get it right all the time, but you must have a view, not just assuming. It is something that should be deliberate on. Do you understand? There will be, you have conversation, like in the bank, you have what you call maybe ALCO, Asset and Liability Management Committee. So I want to also believe that in the organization, there will also be like an investment committee or something. It will not just be one man taking the decision, doing all the thinking. Because what it does is, so you might be looking at things from a different perspective, right? You might think that you have all the answers or you have ticked all the buttons. Other people will be looking at it from different perspectives. That's why in a committee, it's always advisable to have people from different functions, different backgrounds. You have a risk person, you have somebody who just wants to make money at all costs, you have a control person. So when this thing is reviewed, everybody brings different perspectives to the conversation. The summary is, for every decision that you take, if you decide to take a floating rate loan, there's a reason, because you feel that interest rate will drop. That is why you're taking that loan, and it's a floating rate loan. So what you want to do is, when interest rate will eventually drop, your interest cost will drop, right? So it will be a problem where you just go to a company and just take a loan. There is no conversation within the team about the direction of these macroeconomic variables. Is very, very important. Do you understand? So having taken the loan, of course, you are exposed. The only thing you can do is you can now look at your market. If you now come back again and feel strongly that interest rates will continue to go up, then you need to hedge your exposure against that risk, right? So depending on what is available, that is what will determine what you do. So if it is possible for you to get products that you can leverage on to hedge your exposure to interest rate movement, you will do that. If not, you will continue to be exposed. What will now happen is you will now work hard. Those assets, you will sweat them the more to generate more earnings for you, right? So that is just what I can say. I don't know if I've been able to answer your question.
Yes, you have been able, sir. Thank you, sir.
Okay, thank you. Okay, so I want to read the comments before I answer. So the first comment, somebody is saying, I'm sure this person worked in the fintech, and the person is saying, are there regulatory requirements for financial institutions, especially fintech, to conduct the test, and how often? Also, how best is stress testing conducted? My understanding is that credit risk constitutes about 80% of factors that constitute stress for a portfolio. How true it is, and how does it mean on grade? So what I can say is, so it's a function of what you have. So first and foremost, you must have something, right? Even the Bible says, show me what is in your hand, right? So you must have something in your hand. If you don't have anything in your hand, then you cannot conduct stress testing, all right? Except if you're conducting stress testing just to form a decision, an investment decision. So if, for instance, let's say I'm a bank, it's possible that the kind of loan I have will be different from the kind of loan bank A has. It's also possible that as a bank, I don't even have much exposure in terms of FX rate position. So what am I saying technically? Stress testing is conducted on what you have. So if you are a bank, you don't even have credits. Like in my organization, I have subsidiaries. Their loan to deposit ratio is not even up to 2%. So for that kind of subsidiary, when they want to conduct stress testing, the impact from credit portfolio will be very, very marginal, right? Whereas it's possible that they have more of their investment in government securities. So when they are conducting stress testing, right, maybe liquidity, right, maybe interest rate, that it will be the focus of their stress testing. Then in terms of regulation, where I work, yes, there are regulations that guide stress testing. I don't know much about fintech, but the thing is, it's also important for us to understand that it is not just about ticking the buttons, meeting regulatory requirements. It's about incorporating the results of stress testing in the way we run our business, right? That is the only way that we can hand over that business to the next generation. If we just conduct stress testing as an academic exercise, just to fulfill all righteousness, then we are not getting it right. All right. So even if there's no regulation from your end, what I can advise is look at your portfolios that you have. If you have portfolios, look at your portfolios. Do you have portfolios that are sensitive to changes in interest rate? Do you have portfolios that are sensitive to movement in exchange rate? Do you have portfolios that are sensitive to movement in commodity prices, in equity prices, right? So check the portfolios that you have. Check your portfolios. Are there liquidity implications? If something happened, let's assume that you have lines from banks, right? I know most of the fintech, they have lines. They take loans from bank and they give them to customers at flat rate, making so much spread, right? So if you have that kind of situation, imagine a situation where something happened in the banking industry and that line is no longer available for you to utilize. How will that impact on your business? Those are some of the things that you should be thinking about, all right? So I don't know if I've been able to provide some level of comfort to Sunday. If not, you can also drop a comment for me. Okay, so this is from
Perfect.
Sorry?
That's very clear, sir. Very well clear.
Okay, thank you.
Sir.
So I have another one from Mfa Tabu. His question is around liquidity risk. We know the idea is to turn interest-bearing liabilities into interest-bearing assets, which is where you talk about borrowing 2 billion from Professor Adeleke and investing. When we invest, especially in short-term and near-term liquid assets, looking at the case of SVB, the 2008 global crisis and 2020 COVID, how can poor market liquidity make market risk worse for an institution doing so? So like I said, so remember I spoke about liquidity risk in two ways. There are still other forms of liquidity, but I just focus on these two. And I said funding liquidity risk. So where you are able to meet your obligations as they fall due. For instance, you have a rent to pay in December. You won't wait till December, or you have a wife that is pregnant, right? The pregnancy, the wife will not give birth on day one of the pregnancy. You have 9 months to plan. Now, if on the day of delivery, the baby, you are not able to get the necessary things that the baby needs, it means there's a liquidity risk that has crystallized. So it is expected that you will plan your funding, plan your savings, plan your cash inflows, so that when the 9 months is due, all the things that the baby will require, you'll be able to meet those requirements. You also have the one that relates to asset liquidity. So you can have an asset that is liquid today, very liquid today, but there could be an event in the market that crystallizes such that everybody is trying to be alive. Everybody is trying to be alive, right? But you have an asset. Initially, it was liquid when the market was normal. Now, everybody wants to survive. It will be difficult for you to be able to liquefy that asset, right? So you can also have a situation where there is no market event, but there is an institution-specific event, because people know that it's like you have a property or you have a car. Imagine you have a car. You just bought the car. Your friends, they know that you just bought the car, but you want to relocate, and they know that you cannot relocate to Canada with that car. You must sell the car. And it's a car of 40 million. You will be shocked that your friends will be pricing that car for 2 million, because they know that you don't have an option. It is either you sell the car or you abandon the car in Nigeria and leave. In that case, because it is going to be a distressed sale, even when it is supposed to be an asset with high liquidity, right? You will be exposed to liquidity risks. So that was similar to what happened to Silicon Valley. They had assets that were liquid, yes, but there was pressure on them to meet outflows. They wanted to liquefy the assets, and they were struggling with the liquidity of those assets to be able to liquefy those assets. The liquefaction was not coming as fast as the withdrawals, and they could not survive this. All right, so this is from Oluwafemi Olatoye. He said, in the area of stress testing, I understand that there are peculiarities in organizations' stress testing framework based on their industry and business models. Yes, you're right. However, I want to confirm the fundamental areas that should be stress tested in consideration. I've already spoken about this one, right? And I said it's a function of what you have. The Bible says, show me what is in your hand, right? So if I don't have dollar, I can't be stress testing on dollar. So, but if I have like $1,000 in my account, right? From time to time, I'll go and stress test the portfolio. What if dollar dropped by 5%? Sorry, what if Naira appreciated by 5%? How much would I have lost? Maybe to remember the capital market in 2007, 2008, right? So people entered the capital market, but they were not able to set limits, to set benchmark, to say, okay, yes, the capital market is booming, but let me even stress test the capital market. Let me stress test my position, my equity position. Okay, what if the market should drop by so percent? How will that affect my position? Maybe supporting a lot of people, because I can tell you that a lot of people in my previous life, they took their mortgage loan, they used the whole of the mortgage loan to invest in capital market. At the end of the day, in fact, they took margin facility, which was a form of leverage. So you have mortgage of 50 million, you give it to the organization, they give you a margin facility and top up your capacity up to 200 million. You now invest the whole 200 million in capital market. When the capital market started going down, most people lost everything that they brought to the capital market. Why? Because they were not testing the market to take decision. Supposing they were testing the market, they would have been able to say, if the market gets to this level, I will exit the market. But they just allow themselves to be controlled by whatever the market gives to them. So like I said, testing is a function of what you have. If you don't have any credit exposure, there's no need for you to conduct testing on credit portfolio. So you can only test based on what you have. And then as risk managers, let's try to move away from this idea of I am testing because it's a regulatory requirement. No, it should be I'm testing to help the organization to take better business decisions. Okay, so this one is, can GDP affect market risk portfolio? Of course, GDP is a market variable. When I want to, for instance, where I work, we are exposed to solvents. We buy debt instruments. Even in Nigeria, you have foreign portfolio investors. They come to Nigeria to buy government securities, right? So when they are buying these securities, of course, for you to do a country risk analysis, if you want to rate a company, you want to do a risk rating of a company, these are some of the factors that you consider, right? Their GDP, it gives you an idea of the potential or the opportunities of that country to grow, right? So if you have a situation where the GDP is going to drop, the projection is that a country's GDP is going to drop, right? It's like saying a business, the projection is that their profitability will drop. It is just similar to saying the profitability of a quoted company will drop. If that news comes to the market, it is expected that the share price of that quoted organization will definitely drop. Okay, so this comment is on AI. Advent of AI cannot be ignored. We have spoken about macroeconomic variables extensively. As risk managers, should the use of AI be included as one of the variables to be considered in evaluating this due to the possible unreliable responses? When it comes to AI, right? So, like I said, if you don't understand what you're doing, please, I will not advise you to use AI, right? So I work with AI. Sometimes when I push some things to AI, it gives me responses. When I look at those responses, I know those responses are not correct. It's not as if they're not correct. Maybe AI is looking at it from one directional response, whereas I'm looking at it from multi-directions. So it's only when you understand what you're doing that I will advise you as a risk manager to use AI, so that when AI gives you those options, you can challenge AI. And when you challenge AI will appreciate you and go back to, in fact, let me tell you, for you to use AI, you need to understand it, because when you give AI the right direction, AI will give you the right output. But if you don't understand what you're doing, AI will give you anything, you just work with this, and if you're not careful, you may be sacked from that job. So please be equipped with the theoretical, right? And that is why I'm saying it's good for you to also, as risk managers, not just MRM, also engage in some international professional qualifications. They will give you some level of exposures, right? And it is better to remember theory is ahead of practice. Practice will always play catch up, right? Theory will always be ahead. So when you understand the theory, right, then you can engage AI, and like Uzamaka said, like, in fact, it's so amazing. It's so amazing what AI can do if you know what you're doing. How does fiscal variables affect this portfolio? That is what we have been discussing. Fiscal variable, right? At the end of the day, it's the fiscal variable that will play out in interest rate. It's the fiscal variable that will play out in the exchange rate. All these things, they will play out in this market risk factors, interest rate, equity prices, commodity prices. These are the outcome of fiscal variables, right? This one is from Victoria Chuku. My question is for, okay, Prof. Okay, this one is for Prof. Prof, they are saying, can the recorded version of this seminar be shared to all the classes? So this is for Prof. No response is expected from Prof, just for your information. So I will share the slides. I have not shared this. After the training, I will share this slide with Prof so that Prof can circulate to all the participants, interested participants. Thank you. So this one is from Jacob. What are the advantages of recording instruments held to maturity as amortized cost on the balance sheet? Or is it better to recognize at fair value? Or is there a principle around these two means of years? Before we used to have what we call tenting rule. Tenting rule. So, like I said, we have three portfolios. We have the old names. So you have the held for trading, you have the available for sales, and then you have the held to maturity. So new name, fair value through other fair value through profits and loss, that is for trading, held for trading. Fair value through other comprehensive income, that is for available for sales, and then amortized cost is for held to maturity. And with the replacement of tenting rule, what is tenting rule? Tenting rule before is a rule that says, remember, for your held to maturity, you don't mark it to market. You don't carry out revaluation on your held to maturity, because the whole essence is to hold it to maturity. So you are not going to sell it at any point in time. So you don't fair value it. It has no business. The only thing is, yes, it's interest sensitive. If interest rate changes, for instance, if interest rate is going up, the value, economic value of this portfolio will reduce, right? Which is what we call economic value of equity. So it will be affected. So interest rate will affect this portfolio on the long run. So it's a long perspective, right? So you don't market to market. So even if rates are moving against you or prices are moving against you, you'll see where you are, all right? Now, for trading, you are expected to market every day. And the gain or loss will go to your profits and loss account. For your available for sales, you have two options. You can hold it to maturity, or you can decide to sell it anytime you like. But usually, the best practice is, because the portfolio is not expected to be an active portfolio. So when I mean by active portfolio, your trading portfolio is expected to be an active portfolio. You're buying and selling on that portfolio at every point in time. The activity is for you to be buying and selling. Therefore, on your trading portfolio, we'll have what we call maximum holding period. So I'll put a cap on how long you can hold any security that you buy into that portfolio. The whole essence is to make sure that I am seeing activities on that portfolio. Whereas for your available for sale portfolio, there are two angles to it. You are holding to maturity, and also you can sell along the way. Now, because you can sell along the way, but that is not the primary objective. Therefore, I will put what we call a minimum holding period. So I will restrict you from buying into that portfolio today and selling from that portfolio the next day. Because if that is the objective, then use trading portfolio held for trading. But if that is not the objective is more of strategic, then I will define a minimum holding period so that when you buy into this portfolio, you cannot sell until after that period. And then on this portfolio, by IFRS requirement, you are expected to mark to market this portfolio. The only difference between the two is whereas you're marking to market and the gain or the loss for your trading is going to your P&L, for this one, when you mark to market, the gain or the loss is not going to your P&L, it is going to your capital, directly to your capital. Remember, anything that goes to your P&L does not stop at your P&L, it ends up in your capital. But this one will jump past the P&L and it will go to your capital directly. So now the implication is if you don't have enough capital and you have AFS portfolio, even though it's not trading portfolio, if you have losses due to changes in macroeconomic factors, due to changes in market risk factors, you will be recording unrealized losses. And those unrealized losses will be eroding your capital. Remember, where I work, if your capital is not robust enough, the central bank will come for you. So what it means is if you know that you don't have resilient capital, then you don't have any business keeping AFS portfolio or trading portfolio. And then it's also a function of market development. If your market is not developed, right? Because remember, you must mark them to market. And when you're marking to market, what it means is there is a price that is not just known to only you, but there's a price that is known to everybody in the market. The price is publicly available. For instance, if I go to the CEMAC region, if I go to a Cameroon, if I go to a Gabon, if I go to a Congo Brazzaville, if I go to a Central African Republic, their market is still very, very shallow. So as a risk manager, I will not support a situation where they are maintaining such kind of portfolios that you're supposed to fair value on daily basis, when their own prices are released every month. In fact, even sometimes you can wait for 2 months, you don't even have any price. So price discovery is very, very important if you must maintain this position.
And Mr. Edward, if we will allow you, you just continue to.
Okay.
Thank you very much for your presentation. I'm sorry that I'm stopping you at this time. It's because you know our practice is that the seminar will hold between 10 and 12, after which the students will now be engaged online for other classes. So on behalf of the Department of Actuarial Science and Insurance, I would like to sincerely thank you, Mr. Edward Ifeanyi, for delivering such an insightful presentation at this monthly seminar series. Your depth of knowledge, your clarity, practical perspective have truly enriched our students. You know, even we too, that are the facilitators in the department. So we especially appreciate the way you connected the theory to the real world application, and including the way you answered and cleared the students' questions. So once again, I want to thank you for an excellent and engaging seminar. We'll be looking forward to welcoming you again in the future. And you know, as our practice, we know we don't have a token. We don't have much, but we have a plaque that we shall present, you know, to you. So we'll be bringing them personally to your office to say a big thank you. So, and I know the students will really appreciate your presentation. So if the class governor can please put a word to this vote of thanks, I will appreciate it. Thank you very much.
Yeah. All right. Thank you, Prof. We are so proud of what we have had so far, because this is not just an ordinary seminar. This is really, really loaded. Thank you, sir, for your wealth of knowledge, the ability to conjure the theory and the practical aspect of it to broaden our horizon. Thank you so much, sir. It's been a rewarding session. God bless you, sir.
Mr. Coordinator, you can close the session.
Thank you so much, Mr. Ifeanyi Edward, for your insightful presentation. just like every other person before me have said, we really had a scintillating moment with your presentation, and we really enjoyed the depth of your knowledge that you have tried to impart to us. We really appreciate you, and we will gladly come and give you our token of appreciation, like the HOD has rightly said. We bring the plaque to your personal office. Thank you once again, and thank everybody for joining this seminar series. We look forward to another interesting one coming last Saturday of this new month that we are entering. Thank you all.
Thank you. Thank you all. Thank you for the privilege. Enjoy the rest of your day.
Yeah.
Bye.
Thank you, sir.
Thank you, sir. Thank you so much.
Thank you so much.
Thank you, sir.
Sir.